Most people think the way to become a millionaire, rich trader is by finding a strategy that wins 90% of the time, or by catching the next GameStop, or by buying a magic indicator from the PIP unicorn for $1,997. And let me tell you what's wrong with all three of those. Number one, finding a strategy that wins 90% of the time is possible, but you're going to do so with a very skewed reward to risk ratio. You're going to be winning like 5 pips and losing like 100 pips when you lose. So over a long period of time, that strategy is not going to work out at all. Number two, finding the next GameStop is going to be similar to hitting the winning lottery numbers whenever it's at $100 million. Very rare situation. And number three, do I really need to explain why buying the magic indicator from the PIP unicorn is a bad idea? The PIP unicorn does not have your best interest in mind, trust me. So what I've found throughout my trading career, which at this point is a decade long, which is crazy, is that keeping things as simple as possible and honing in on the basics is what really creates profits, at least in my own trading. And the basics that I focus on in order to capture some of the biggest moves in the market and get some of the most accurate trades that I've ever gotten consist of 5 very simple steps. Spotting major levels of support and resistance with a rules-based systematic approach. Trading price action patterns that are time tested and proven to still be profitable, like double bottoms and head and shoulders patterns. Knowing where to put my stop and my target so I have a good chance of winning the trade and not being stopped out, but also a more than 1-to-1 reward to risk ratio. Having a solid risk management plan that keeps me out of my emotions so that every single trade I lose is not like breaking up with the girl of your dreams or guy of your dreams, whatever you're going through. And staying disciplined to all of those factors in my trading is what has created the profitable trading career I have right now. So in this video, what I want to do is break down all 5 of those steps for you and get you a little bit closer to that final goal you have of becoming a rich trader. So if that sounds good, go ahead and smash that like button for me. It helps out with the YouTube algorithm. Go ahead, hit that subscribe button if you're not already. It's red right below the video and it says subscribe. While you do that, I'm gonna let the intro and disclaimer roll and I will see you directly after. So first off, let's dive into support and resistance. Simply put, support is nothing more than an area that price is supported by the market. For example, if you look on the chart with me, you can see that we have an area looking left here where the market was supported in the past. The market came back down to that area and was supported again. Resistance is just like what it sounds as well. And resistance is when the market gets to an area that previously was resistance. If we look left, you can see that this market found resistance here in the past. Once we get back up to that area, there's a high likelihood chance that we see this market have resistance from this area yet again. So that is the what of support and resistance. And now I'm going to break down how to find the most likely areas of support and resistance to trade from. So let's do that on the euro dollar. Here we are on this currency pair, and the 2 ways that I define major levels of support and resistance are the most recent levels of structure that were broken and levels of structure that have been tested multiple times in historic data. Because for support and resistance levels, all we're looking at is historic price and the way the market's going to react from that historic price. Does it happen 100% of the time? No, but judging support and resistance based on historic price is something that can give us an edge in the market. For example, when a level of support is broken like this, that level of support oftentimes becomes the next level of resistance for a particular market. So in this case, we had a level of support right here. Once broken, as you can see, the market came back to that level and it became resistance. Now the same thing can happen on a bullish trend. This was an example of a bearish trend, but on a bullish trend, what we see is the market pushing higher and then coming back into a previous level of resistance. So in this case right here, what we see is the market pushing up our higher high right here. It creates our first resistance level before the pullback. After that pullback and the break of this level, the likelihood is that we come back to that level and the market continues in trend from there. And when I say the likelihood from my testing and my trading experience, there's about a 65% chance whenever the market gets in this area and use a specific entry reason for the market to head higher. So with that being the case, this gives me the edge that I'm looking for, okay? We're not going to be able to win 100% of our trades. No one ever will. But what we try to do as traders is gain some kind of edge over the market with a higher winning percentage than 50-50 or a larger risk to reward than a 1-to-1, winning at about 50% of the time. So just to prove to you how well this works, what I'm going to do is play you a clip from last week's video on the euro dollar. And before I do, let me show you the analysis we had last week. The market was about right here. And what I said is that I was expecting this market to come into our area of previous support that's just been broken. What is that now called? Possible resistance, right? The previous support level that was broken is now likely to become resistance. So what I said last week in this video you're about to watch is that I was waiting for the market to get into this zone, then waiting for short opportunities for it to continue lower. Let's check out last week's video and then we'll check out what happened, even though you already saw it, but I'll talk you through the entire mindset once we get back. Check out that video clip and I'll see you in a second. Bias to the downside on this pair. So if we get a pullback into my area of value, this is the part about being prepared. If we get a pullback into this area right here that is in red, that will be an area I look for possible short trades. Reason being, because trend wise, we're in consolidation slash a slight bias to the downside, considering we just broke a previous higher low and closed below it with this candle. We now have an area of value the market's used multiple times as support and resistance. Okay, so when using this type of trading strategy, this type of structured trading plan, what you want to do first is get your bias of that market. And what I mean by bias is, am I expecting this market to go higher or lower based on the trend we're currently in or on what is happening with price? And in this case, what we had is the euro dollar breaking below a previous low. If the market was positive of what it wanted to do, if all the participants in the euro dollar wanted this market to go higher, what would have happened? If the market was positive and very sure that it wanted to go higher based on the decisions of all market participants, then we would have seen a higher low and a higher high. What actually happened? Well, we saw not a higher high and higher low, but instead a lower low, which indicates the next likely scenario is going to be a lower high followed by a push down. So with that being the case, my bias, that's my first step when trading this type of strategy, my bias is to the downside right now on the euro dollar. While we were looking at the market last week, that's what I was saying. So with my bias being to the downside, my second step after figuring out what my bias is based on what price action is done, the second step is always finding the most likely area of value where the market will continue in the directional bias that I have. So if I have a bias to the downside, what I want to do is look for an area of value. And the way we found that was the most recent level of structure support that was broken, and it also happened to be tested multiple times. So I'm not just looking at the most recent level of structure that was broken. I also want that level to have been tested multiple times in the past. If I get those things coming together, then the next step is me waiting on an entry, which is something we're going to talk about in just a second. I want to continue here on the support and resistance part of the video until we're completed with it. So in this level is where I'd be looking for possible price action patterns. Again, we'll go over that in a second. Let's take a look at what happened. So as you can see, the euro dollar played out very well considering the analysis we had last week on this pair, coming into our area of value after our directional bias was made and shooting down, creating a lower low. So if we are playing this in the same exact way, if I'm going to be consistent with my analysis, then what is my breakdown of this chart right now? Right now, what I'm seeing is a market. What's the bias right now? The bias is going short, correct? Why is the bias going short? Because we just broke below and closed below the previous level of structure, then made a lower high and then a lower low. You'd be surprised at how much easier it'll make it if you just start drawing out your highs and lows on price. Eventually, when you get to the end of price, you'll know what your directional bias should be if you just draw out highs and lows until you get to the end of where price is right now. So with this being the case, then I have a bias to the downside. What's my area of value currently on the euro dollar? Well, looking left, hopefully you were able to spot this zone right here. Why? Because it not only is the most recent level of structure support that was broken and closed below, but also is a level that was tested multiple times. So with that being the case, this is absolutely my area of value. So right now, think about how much less confusing trading is if you decide to trade a strategy like this. Right now, instead of just looking at a chart, placing a trade randomly because I'm not really doing any analysis, I'm instead preparing for what price could do in the future. And now, instead of saying, I'm going to jump on my charts and just place a trade, now I get to go, okay, if this market pulls back up to the area of value, considering, you can make it so logical, considering the fact that we're in a downtrend and that this is my next area of value, I now know that this is an area I want to look for possible entries. So that's the first way of spotting support and resistance, is what I call the recency bias. What was the most recent level of structure that was broken? The second way is one that's more about frequency. Now, because this resistance level wasn't the most recent that was broken, we had this level and this level broken, but even though that's the case, because of the fact that we have a level that was tested so many times that the market's coming down into right now, I'm seeing this level as a major level of support. So the two things we want to look for when looking for major support and resistance levels is how recently was this level tested and how frequently was it tested. Frequency and recency are two extremely important factors when spotting major levels of structure. So with this being the case, even though my bias in terms of trend is to the downside, very obvious to me that this market wants to head lower. While the market's trending down, what happens? Does it just go straight down in a straight line like this? Or do we have pullbacks? Do we have retracements? Does the market need to take a break from this big down move in order to retrace and then keep going down? That second part is the answer, right? It needs to retrace. It needs to have some kind of a relief from the big downtrend. And what I'm doing with these types of levels that are below price in a downtrend is finding counter trend zones to catch that pullback and possibly make money on that pullback, because I want to have as much frequency in my trading as I can. I want to trade as frequently as possible once I find an edge over the market. Once I find a way to get a 65% chance to win, even if it's with a 1-to-1 reward to risk, I want to exploit that edge as many times as I possibly can. So finding this major level of structure, even though we're in a downtrend, is how I exploit the edge even further by looking for possible bounces. Now, the important part of this is knowing where to put your stops and targets so you have a really high likelihood of hitting your target without looking for this complete reversal in the market to go to the moon like GameStop and Dogecoin. That's not what you want to be looking for in these zones, because you're counter trend trading. You're just looking for that pop. Just a nice little bounce out of price before the continuation of the downtrend. So with that being the case, let's move on now, because at this point you should have the structure levels, how to spot them, figured out pretty well. This is how I spot my major levels of structure. That was the first step, remember, in the 5-step simple process of what, honestly, the very first time I became a profitable trader, the first month I made profits, this is how I traded during that month. It was exactly like this. And then I continued and was consistent with it, also started improving it as I went forward with my trading. Next up, what we're going to be looking for in these zones, because it's not enough to just have an important zone of structure. Just because I know where a zone of structure is or where the market's likely to turn around will not make me a profitable trader. What makes you consistently profitable is consistency. So what is my consistent way of entering trades in these areas? If you've been a part of the channel for a while, then you know what CEST is. Our conditions are met. What's our bias to the downside? What's our levels of structure, areas of value? Those are conditions, not entries. I have no reason to enter the market yet. Your entries are going to be made up of price action patterns, candlestick patterns. You could use indicators. It's completely up to you. But for me and for the strategy I'm talking about right now, the way I enter the market is with simple price action patterns on lower time frames. So in the case of the euro dollar, without even looking for the counter trend trade, because I know that might get confusing for beginners and I want to keep this super simple. So if that is confusing, feel free to not even pay attention to counter trend levels right now. Feel free to just use the trend continuation levels. So if we were doing that, the case would be we have a bias to the downside on the euro dollar. We have an area of value because the market just broke the previous level of support to put us into this downtrend. So with those two factors being the case, I know what I'm waiting on to trade in the next week or two, and that is a pullback to this area. Once all of those conditions are met, the entry that I'm looking for are simple price patterns like double tops and double bottoms. That's it. After that, of course, we got to move into stops and targets, which we will do in a second. And I am going to break down all the top 5 major pairs and show you the areas of interest that I have and how I'm planning to trade in those areas coming up a little bit later in the video. But in the case of the euro dollar, what we'd be looking for is a double top in this area. Now, for a double top, my rules are the double top itself is not the entry. I want to see a double top with at least one red candle on that second top. That red candle is my entry, because if I just have a double top, the market could easily do this and head higher. But as long as I wait on a red candle in this area to show me that we have some kind of bearish pressure pushing the market down from this double top, then that increases my odds. The market could still obviously push up, but it increases the odds dramatically to wait on that confirmation. So the actual entry itself is not just a double top, not just a double bottom, but a double top or double bottom with the same color candle. If it's a double bottom, a green candle, or a double top, a red candle is the actual entry reason. Now, what I want to do is actually show you this price pattern that I'm looking for on real chart data to make it easier to understand. Then we'll go over stops and targets, how you can pick the best place to put your stop so you're not whipsawed out by the market constantly, and how you can manage to get a more than one-to-one reward to risk and still maintain a decent winning percentage on your trades. Let's dive into double tops and bottoms on a real chart. Okay, on the screen, you can see a valid double bottom trade. What I'm looking for with a double bottom is at least one bottom to happen, then the neckline to be created. Then whenever the market comes down and retests that first bottom, I want to see a green candle before I make an entry. That's extremely simple. That's as simple as I could possibly make double bottoms, but also you want to make sure you have a certain set of rules with your price action patterns. Otherwise, there's a lot of subjectivity in your trading, and that's not something you want. So again, you want to find that first bottom, your neckline, your second bottom, and at least one green candle. It's the opposite for a double top. Next up, let's talk about stops and targets. So in this exact situation, where would my stops and targets go? Let's say we have a major level of structure looking left at this area, and then we come down here and we create this double bottom. The way I would place this trade, I'm going to grab a position tool just because it makes it easier, is at the close of that green candle, I would have my actual entry. After having the actual entry, I would look up at a really handy indicator, probably the indicator I use more than any other indicator on any platform, and that is the average true range, or ATR indicator. This tells you the average of the movement over the last 14 candles, which keeps you out of most whipsawing situations because it accounts for the volatility of the market, which is something you obviously want whenever it comes to like having a stop loss, a set stop loss. You want to make sure you're accounting for volatility. So right now, the green candle that we have, the ATR of that candle is 38 pips. What I would do is have a stop loss 38 pips below the swing low right here. So right now, down to that swing low is around 73 pips. 73 plus 38 is 111. So I would have a 111 pip stop loss in this particular case and on this particular trade. And then for me, I want to make sure there's no major structure in the way, and I want to set at least a 1.4 to 1 reward to risk. That is the way I trade these in terms of stops and targets. So now at this point, quick little recap before we move on. You have the way of spotting major levels of support and resistance. You have the patterns that I use in these areas of support and resistance. You have how I manage my stops and targets in order to have more than a 50% win rate and a better than 1-to-1 reward to risk ratio. If you were just to take that, constantly stay disciplined to it, and it continued to perform just like that, you inevitably would be a consistently profitable trader. But there's something else we definitely need to talk about, and that is risk management. Because without having a risk management plan that keeps you disciplined and keeps you from freaking out every time you press the buy button, every time you're in a trade, the only way we can keep from that emotional turmoil happening is by having a solid risk management plan. So let's talk about that right now. All right, so don't leave because you think the risk management portion is going to be boring or whatever. As boring as it sounds, risk management is going to be one of the main causes of you either blowing your account or staying in the trading game long enough to become consistently profitable. And as soon as we're done with the risk management section, I'm going to go over the top 5 major pairs and explain to you all of the trade setups I'm looking for coming into next week. So that's going to be extremely valuable, and that's the reason you should go ahead and smash that like button. Make sure to stick around though through this part of the lesson. So if you can imagine this with me. Imagine looking at the market right now saying, oh, look, we're in a zone of structure. That's awesome. Steven said that when we're in major zones of structure, I need to buy. That's not what I said, but let's just pretend that's what your thought was. And you buy, but you don't really have an idea about risk management. You think it's okay to lose, let's say, 10% of your account. And if you don't go by percentage, what you need to think about, if you're not going to go by percentage, is what's an amount of money that you're comfortable losing. One of the best things for me in terms of helping me with risk management, as I heard from a guy one time, it was some guru that I was watching at the time, and he said, every time you place a trade, you need to ask yourself, is it worth the risk? Because there is a pretty high likelihood that you lose that trade. I know you don't want to think about trading in that way, but even as a professional trader, some of the strategies I have will win at about 55% of the time. That means that there is a very high likelihood, about 50%, a little bit less than 50% chance that I'll lose that trade. That would be like flipping a quarter and going, okay, I'm willing to lose $100 by flipping this quarter. So if you don't know the statistics of your strategy yet, you need to go do some back testing, do some forward testing, and find out how often you win and lose. But if you've already done that, the way you need to think about it, especially if you have a strategy hitting anywhere near 50%, is you have a 50% chance of losing that money. That would be like flipping a quarter with that money on the line. So if you were just flipping a quarter, would you be willing to bet $100? Because you have a chance of losing that $100. Is your risk worth $1,000? Is that okay with you to lose $1,000 on a trade? You have to think about these things because there's a high likelihood that you will lose the trade. We don't make money on one trade at a time unless you bought into GameStop. We don't make money one trade at a time as professional career path, consistently profitable traders. We look at a sample size of a very large amount of trades, like 100 trades. And in order to stay safe and sane throughout that 100 trades, we have to keep our risk small, like 1% of our total account size. Maybe your risk tolerance is a little more than that, and you do 2%. It really is less about what percentage you risk of your account and more about you taking a look in the mirror and asking yourself, what am I willing to lose on any particular trade? And then if you know the statistics of your strategy, ask yourself, how many times did it lose in a row in historic data? If you've actually put in the work already. If not, go back test, figure this out. Ask yourself, how many times did it lose in a row in the past? Was that number 10? Was that number 5? Let's say it was 10 for easy math. If it lost 10 times in a row, chances are throughout future trading, it will likely lose 10 times in a row again. So if that's the case, you got to multiply whatever you're risking per trade by 10 to see if you're comfortable with it. So if it's 2% per trade, are you comfortable losing 20% of your account at any one given time in terms of any one given amount of trades, over 10 trades? Are you comfortable losing 20%? Is your number higher or lower? Maybe it's a dollar amount. Are you comfortable losing $2,000? Because if you're trading with $100 risk per trade, you lose 10 trade, or if you're trading with $200 risk, which would be like 2% of a $10,000 account, and you lose 10 times in a row, you're down two grand. If your number's higher, that's fine. If it's lower, that's fine. You need to stop paying attention to what people say you should risk and start looking in the mirror and asking yourself, what's a number I would be comfortable with? That's the risk management portion of this. And the reason we do it is because of number 5. That was number 4. We've made it almost all the way through this 5-step process. Number 5 is staying disciplined to whatever strategy you're trading. It could be a strategy like this or something totally different. If you can't stay disciplined to it, then you're not going to be a consistently profitable trader. You're going to jump around from strategy to strategy, and you're going to waste a shitload of money trying to trade. So if you don't think you're going to find a way to stay disciplined to a strategy, please just stop trading now. I know that sounds weird coming from a professional trader that's teaching on YouTube, but I don't want to see you waste money in the markets. And if you can't be disciplined and have a good risk management plan, you're just wasting money and time. You're wasting time you could be spending with your family. You're wasting money you could be putting into learning a different skill that could actually make you money in the future. So with that being said, staying disciplined is one of the most important parts of trading. And one of the ways we do that, one of the main ways, is by having a solid risk management plan. So having that risk management plan in place will help you stay disciplined. The second step to staying disciplined, we've talked about a little bit in this video, is backtesting. Take this strategy, go through historic data, open up 2 windows, like this, stay on the daily chart on one of them, stay on the 4-hour or 1 hour, whatever other time frame you decide to trade. If you're going to do multiple time frame testing, it's tough, but this is how you do it. And then go through historic data and look at how many times did it win versus lose. If you came out with a positive expectancy, it's going to do wonders for your confidence. If you combine that with having a good risk management plan, you're set. You should be able to be disciplined to that strategy. That's how you gain discipline. I get this question all the time from traders in our program, and also just from random traders that email me on a daily basis of, Steven, how do you stay so disciplined? Work. You got to work hard and backtest, which takes a shitload of time and effort. You have to work hard to keep yourself disciplined, not get greedy and try to trade with too big of a size, and keep your risk management in check instead of going after something you think is going to make you rich overnight. You have to keep your risk management in check and make sure you're only risking a certain amount per trade. And you have to backtest, because that's what gives you confidence that the strategy is likely to perform well in the future. That's how you gain discipline. There's no easy route to becoming a more disciplined trader. That doesn't exist. It's just through the process of backtesting and keeping a solid risk management plan. Thank you so much for listening to that entire rant. If you did, leave me a comment below. Make sure to go ahead and click that like button. And now we're going to move on to actually looking at the top 5 major pairs and talking about what I'm expecting next. On the euro dollar, we don't have to look at this much. I've already told you. We're looking at this as a level of resistance that is likely to become resistance if we get a pullback into this zone. If we do not, and this market continues pushing lower, we're actually already in this zone of support. I'll be looking for possible long trades. How? With double bottoms and head and shoulder patterns in this area between 1.1958 and 1.1880. If we move on now to the pound dollar, on the pound dollar, last week I said that this was a major area of resistance. I'll show you why in just a second, but just so you believe me, check out this video from last week. Go ahead and play another little clip for you guys. I'll be right back. It's a very short clip. I'll see you in a second. I'm then going to scroll the chart back until I find an area of value. How do we define an area of value? By an area the market is used multiple times as support or resistance. Here, support, area of value, cool deal. Now I just need to go back over and paint this area red so that I know it is an area of resistance. And then we'll talk about the third step, which is what is the likely scenario and what am I going to do about this analysis? Well, for trend, I know we're to the upside, but an area of value this strong can be a nice counter trend area to look for short trades, even though we're in an uptrend, because the likely scenario is that we hit this area and we have at least a pullback, possibly a reversal completely. So with that being the case, what am I going to do about that analysis? That means that between the area of 1.3835 and 1.3755, that's an area I'm going to be looking for possible short counter trend trades out of the pound dollar. So as you can see in that video, we were talking about this area of resistance and the market came up to this area. I'm talking to the pip and dropped with over 200 pips of drop. And this is what I'm talking about whenever I say that I'm not looking for the market to completely reverse from here and just keep going lower. This pullback would have been plenty of pips for me to hit targets on a 1 hour or 4 hour chart. This was over 200 pip drop. It doesn't look like much on a daily chart, but that's why I place my trades on smaller time frames. So on smaller time frames, I would have been looking for double tops in this area. Now for the upcoming week, I'm no longer looking at this as major resistance. If the market gets to this area, I will expect it to be broken, pulled back into, and then possible long trades from this area. What I am looking for is that if this market pushes down, hear how prepared that sounds? If, instead of I'm just going to jump in a trade. No, if this market pulls down to the area between 1.3477 and 1.3378, that will be an area I look for possible long trades. Out of this market, how am I looking for those trades? Double bottoms, price action patterns. Next up, take a look at the dollar yen. On the dollar yen, we are well into the zone that I pointed out last week on this pair. Something has changed this week though, because we do have a new level of support. But let's talk about this resistance area. Why was this resistance? Well, it's a major level of structure that pushed the market around very dramatically, also was tested multiple times in the past. With all of those coming together, this is in fact a major level of structure for me. Now, this is why we don't just place trades randomly in these zones. Instead, what I'm going to do is wait on price patterns on smaller time frames. So go to the 1 hour chart. As you can see here on this chart, we actually don't have any kind of price action pattern. There's no double top in my zone. So at the moment, I have not had a reason to enter a trade, although we are in a major area of resistance. What I'll be waiting on instead is this market to create a price pattern like a double top with that red candle at the end of it. If that happens this week to next week, I will be placing a trade going short here on the dollar yen. Now, as I said, we actually have something new this week to look at as well, and that is this area of support. Let me go ahead and get a green box on the screen to make it easy to see right in this level is an area I see as major support for this market. So if we get a pullback, a heavy one into this zone between 104.56 and 104.26, I'll be looking there for possible double bottoms to push this market higher. But the reason this is a major level is because it is the most recent level of resistance that was broken in terms of time. These levels were broken too, but in terms of time, if we're looking left, this is the most recent level. So that level, because it was most recent and because it was used by this market multiple times, is a level of support I'll be looking for possible long trades out of. Next up, we have the Aussie dollar. The Aussie dollar is currently in an area of support I pointed out last week. We haven't really done anything from this area, so currently still looking for possible trades. And right now, we look like we might be getting, not quite there yet. So right now, on the 4-hour chart, if I end up getting, this is our first bottom, this will be our neckline, right? If I get a pullback that hits my termination zone, let me go ahead and explain exactly what I look for with double bottoms. This would be my termination zone. What I need to see is a candle whose wick, or witch's wick, whatever. I'm looking for a candle wick that touches this area, but I cannot see a close below it with a candle. As long as I get that, and also a candle can close inside of this zone, that's fine too. A wick can go past it, that's totally fine. The only thing I don't want to see is a candle close down here. But if I get the touch of this zone, followed by a green candle, I'll be going long here on the Aussie dollar based on that. So that's what I'm looking for on the Aussie dollar. Let's zoom back out to the daily chart. Has anything else changed here? Not at all. So right now we're set. If this market pushes higher, what I'll be looking for is, and this is going to be over the next couple of weeks if we do push this high, resistance, I'm looking at 79.15 and 78.67 on the Aussie dollar pair. Next up, we have the dollar Swiss. And again, actually, this is going to be the last pair we look at, but check this out. It was a losing trade. Oh my God, crazy, right? You lose trades in Forex too? Yes, everything was right about this trade. Let me explain. We have an area of resistance. If I scroll the chart back a little bit more, you can see why I wanted to trade from this area of value, right? We don't have a bias to the downside because at the time we'd already broken above this resistance level. So I didn't have a bias at all. We were in pretty much consolidation with a slight bias to the upside. But looking for a counter trend trade, I saw this zone as a major level of structure resistance. Once we got to that level, I dropped down to a smaller time frame. And what did I see? This beautiful double top. We're pushing up to our first top. Let me zoom in a little and move this, trying to get this like where y'all are capable of actually seeing it. So here's our first top. Drawing my termination zone on that first top. Right there's the termination zone. If I zoom in a little further, maybe it'll make it easier. And then what do I get? I get wicks that come above the termination zone, and then I get a red candle for entry. Right there's my entry. Why? Because we didn't have a candle close above my first top. We did get a wick that touched it, and then we get the red candle. So there's my entry, and the market did not cooperate whatsoever, decided that my trading strategy is not worth it, at least this time, and moved higher, stopping me out. Losing a trade. Oh no. And if I didn't have a solid risk management plan, this would have felt like the love of my life breaking up with me. It would have been detrimental to my emotions, and I'd never look at trading the same again, which is why risk management is so important, because you do lose trades. That is something that happens to every professional trader, no matter what. But now, what are we looking for here on the dollar Swiss? On this pair, what I'll be looking for in terms of resistance and support looks a little something like this. For resistance, if this market heads higher, what's the next level of resistance we're likely to hit? Is it not this zone right here? Yes, it is. So what I'm going to do is place a horizontal line in this resistance area, and that is going to be where I look for possible short trades. Why? Because this is a recent area of resistance that pushed the market around. It also has been tested multiple times and reacted to by price here on the dollar Swiss. In terms of support, I'm looking right down here at the previous most recent level of resistance that was broken. Because this is the most recent level tested, it also has been tested multiple times by this pair. So with that being the case, I now have resistance and support pointed out, and I know exactly what I'm going to be doing if this market continues higher or if this market turns around. If we end up pulling back to this area, looking for those double bottoms to push the market higher, If we pull up to this area, I'm looking for that counter trend double top before the continuation of this uptrend. So that's how I use this 5-step process, and it will work, guys, on any, I say will work, go test it yourself. Don't just believe me blindly, but you can test this on any time frame. We're on a daily chart. I trade 4-hour and 1-hour time frames. That's why I use the daily for my higher time frame. If you trade 15-minute and 5-minute, use the 4-hour for your higher time frame. Just go up a couple of time frames every time you want to switch time frames and using a strategy like this. With that said, hope you enjoyed it. If you did, smash that like button. If you're interested in some more advanced training, we do have the EAP Training Program, and we do have some space available in that program at the time we're talking right now. That program is linked in the description, labeled VIP EAP Training Program. In it, you'll learn more of the strategies that I use on a daily basis. You'll also learn how to deal with your emotions better as a trader. You'll learn about risk management. The program comes with what I call the Pro Trader Report, which is me sending you an email telling you the areas I'm paying attention to trade in throughout the week. It also comes with a video I do every Monday called Best Setups of the Week. You have email analysis, which is 3 to 5 email alerts I send out on a weekly basis, telling you about the trades I'm taking based on the strategies you're learning in the course. It also comes with priority email, where you can get in touch with me at any point that you have questions. And best of all, it comes with a 60-day money-back guarantee. If for any reason you are not satisfied within the first 60 days, which should be plenty of time to know whether or not you're going to be satisfied, then you just email my support staff and they will get you a refund ASAP. So risk-free offer there. If you're interested, it is the first link in the description. If not, totally fine too. Make sure you keep it locked here by subscribing, click the notification bell, click that like button one more time for me, unless you dislike it by clicking it. If you've already clicked it, don't click it again. If you haven't clicked it yet, go ahead and click it, and I will talk to you in the next video. See you guys soon.